Hello everyone, how are you all? Welcome back. This is with respect to what we have done in the last case. This is with respect to ACCA financial management. Section A. So this is the series 6, okay? This is the series 6 of 20. 20 maybe I will change, but the most important thing is this is the sequence series 6. That's very important. I kindly request you all, please subscribe to the channel, share this channel, post any comments how best we can improve it. You want any further clarifications, your views, your feedback is very much important. Post your feedback in the comment section, and in the end hopefully you can, if you think it's really added value to your knowledge, please like it, okay? Coming back to this, we have done in the previous till now we did section. This is Kaplan, okay? This is Kaplan exam kit. Fine. We are doing the investment decisions, okay? We are doing with respect to what? This is related to investment appraisal. Is it right? This is related to what? This is related to investment appraisal. Only thing is my handwriting is not that much clear, okay? I try to be best. What it says, Arnold is contemplating purchasing $280,000 a machine which he will use to produce how many units? 50,000 units of protection per annum. For how many years? 5 years. These products will be sold for 10 each. Selling price is how much? Selling price is 10. Variable cost is 6. Incremental fixed cost is how much? 70,000, and the production cost per annum for production cost, and 25,000 for selling. Means you will have the sales price. Is that you will have the sales price? You will have the variable cost. Sales minus variable cost, it comes to contribution. Contribution minus fixed cost, it comes to profit. This is related to management accounting, okay? See how challenging they will link it to the financial management. How many units must the estimate of production and sales volume fall for the project regardless as not worthwhile? To be regarded as not means what is the units of production? How much impact it will have, it will come down, okay? Slowly and steadily we have to do this, okay? Very slow. Next, okay, what we'll do first, we'll put the particulars. See, I told you, okay, it has been as mentioned here. What I mentioned here is, this is what it says, is that you will have the sales minus variable cost minus fixed cost, it comes to profit, okay? We have to follow this concept, okay? We have to follow this concept. Coming back to this particulars, take the cash flow, particulars, cash flow. What is the discount factor? They have mentioned 10%. Is it? Required rate of return is how much? 10%. This is the discount factor. How much is that? I will write like this, DF. DF is discount factor at the rate of 10%. Fine. And present values at the rate. Now you have some understanding how the things are progressing, okay? Now once you have done this, this is column 1, this is column 2, this is column 3, column 4 equal to 2 times 3, okay? Column 4 equal to 2 times 3. Now what is the first initial cash outflow? Is that they have purchased a machine. is it? They purchase the machine. Here we have to put year also. Okay, we have to put year. Year 0. How much is the cash outflow? Cash outflow is 280,000. Okay, cash outflow is how much? 280,000. Okay, fine. 1 minute. 1 minute. Yeah, you put this as a year. You put this as a year. And you put it as a year. Okay, this is year. This is year 0. Cash flow is how much? Cash flow is 280,000. I told you last time also. Any discount rate, year 0, the value will be 1. Okay, the value will be 1. How much will get? 280,000. Okay, 280,000. Next, what they say that there will be 5 years. Okay, there will be 5 years. See the things. How much is there from year 1 to 5? Okay, 1 to 5. How much is there? How many units are there? 50,000 into what is the sales? 10. Okay, 50,000 is sales is how much? It comes to 500,000. This is the sales. Okay, variable cost. 50,000 into times 6. It comes to how much? 30,000. Okay. Now contribution is how much? Contribution is 200,000. This is consistent from year 1 to 5. Okay, year to 1 to 5. This much we are taken here. Okay, this is what we are taken here. How much is there? 20,000. What is here? Because it now I will say because cash flows are consistent. Is it right? Cash flows are consistent from year 1 to 5. Is right? Annuity value table. Is it right? Annuity value table should be referred. Is it right? Should be referred. Fine. Annuity value table at the 10% at the rate of 5 years. At the rate of 10% for 5 years is how much? At the rate of 10% for 5 years is 3.791. Okay, 3.791. 20,000 times 3.791 minus 200,000. It comes to how much? 758,200. Okay, here now there is fixed cost. Is that 1 to 5? Again, it's a fixed cost. Every year they say that per annum. Okay, 25,000 and 75,000. 25 plus 75, it comes to 95. 25,000 is, see, 75,000, 70,000 is for the incremental fixed cost, and 25,000 will be the selling and distribution cost. Is it right? How much is the same thing? It's every year fixed. 3.791. Okay, 3.791. How much it will come? It will come 95. 3.791. 360, 145. Okay, 360, 145. If you take into consideration 280,000 minus 280 plus 758, 200 minus 360, 145, it comes to 118,055. This is the NPV. Okay, this is positive NPV. Okay, positive means if see what the NPV says, that if NPV is positive means it is getting more than the investments. Is it? Now, what is the how much NPV should decline in order to become zero? The moment we will get what they say, what is the how many units must the estimate production and sales fall for the project to be regarded as not worthwhile. Means if the present value contribution, is it right? Present value contribution must fall. How much it has to fall by? How much it has to fall by? 118055. Then only it will become zero. Is it? What is the percentage? Is it percentage of sales volume? Percentage of sales volume is how much? Percentage of sales volume is nothing but present value divided by sales price. Is it right? Percentage value divided by sales price means 118 present value, sorry, present value divide in, I can put it as net present value. Okay. No, we have to put it as a present value. So present value will be decreased by 118,055 divided by sales is how much? 758,200. It comes to how much? It comes to 1 minute. 118,055 divided by 758,200. It comes to 15.57. Is that 15.57%? Okay, 15%. They are asking what? They are asking units. Okay, they are asking units. Fine. Means how many we have to fall in sales volume. Is it falls in sales volume? It comes to how much? 50,000 units times 15.57%. Is it right? 50,000, 15.57%. How many units? 7785 units. Is that what is the answer? Answer is 7785 units. Okay. Please subscribe to this channel, share this channel, and post if your feedback is very important. I'm not seeing the feedback from the people, very less feedback. Okay. You have to subscribe this, share this channel, and feedback is important in either case. Okay. Where we can improve, where we want more clarification, where we need substantial explanations. All the payback period is the number of years that is taken a business to recover original investment from net return. Which of the following statements are true? See what will happen. You will have profit before interest and tax minus interest. Is it right? Then you will have profit after tax minus tax. Is it right? Then you will have so profit. So 1 minute. Is it? Profit before interest and tax. Profit before interest and tax minus interest. Profit before tax minus tax. You will have profit after tax. Profit after tax. What is the cash flow? Cash flow is nothing but profit after tax plus depreciation. Is that depreciation is a non-cash expenses. Okay, there is only we are moving from one account to another account. Actually, depreciation is not going to it's not going to have any impact. Cash flow is nothing but you have to add back the depreciation. It is calculated before both. No, it is not calculated before depreciation. It is calculated before depreciation but after taxation. Means what will happen? This is what it says. You will have the profit after taxes plus depreciation. It is calculated or no or not. It is not after. Okay, it is not before depreciation. Also taxation is not there. It is calculated after both depreciation and tax. The correct answer is B. 83. The data of relevance for the evaluation of the project of the project are given below. It says what? Cost of capital in real terms 10%. Is it right? Cost of capital in real terms. Expected inflation, fine. 1 plus R, 1 plus real terms into 1 plus inflation. Is it right? What they are asking, what is expected increase in the annual cash inflow? Expected increase in annual cash. See, always the cash inflow will be a higher percentage. The cash outflow will be a lower value. Is it right? Cash inflow will be high. Is it right? Compared to cash outflow. Then only the appraisal process will come into picture. Which of the following set of arrangements leads to the correct NPV? Correct NPV means your cash inflow should be more than cash outflow. Okay, that's very simple. Now, what we have to do? We have to calculate. Is that 1 plus real rate? 1 plus money rate. Is it right? What is the formula? 1 plus money rate is equal to 1 plus real rate. 1 plus real rate times, okay, 1 plus real rate times 1 plus inflation. Is that 1 plus real rate is given? How much 1 plus real rate is? Is that 1 plus real rate is how much? 1 plus real rate is 10%. 1.10 times 1.08. Is it right? If you take money rate, is it right? If you take money rate, is nothing but the discounted rate. Okay, is nothing but how much we'll get? 1.08. Is it right? Minus 1. Okay, it comes to 1.188 minus 1. It comes to 18.888 or 18.8%. Okay, now discount percentage is there. How much? Discount percentage is how much? Discount percentage is this is not there. Is it right? This is not there. This is also not there. Okay, now cash inflow. I told you cash inflow because the discount rate is 18.8. Okay. Usually when one correct NP net present value will happen when there is a higher point. See, we have two options. Is it right? We have option of this and we have option of this. Here what's happening? The cash inflow should increase higher than the proportion to cash outflow. Okay, the increase in cash inflow is in term percentage should be proportionately higher than cash outflow. Here what's happening? It's equal. Okay, it's equal. Is it? Here it is going to be equal. Is it? It is not applicable. The answer is here it is 6% increase in cash out inflow and 4% increase in cash outflow. Okay, see, that is the reason when you have to have a very basic understanding about the things how it will work. Fine. Spotty Limited plans to purchase a machine costing how much? Cash outflow is how much? It is going to be 18,000. Labor savings is 9,000. First year labor rates will increase by 10%. The estimate they didn't give anything. The estimated annual rate of inflation is 8%. Cost of capital is, first you have 12%. The machine has 2-year life with an estimated salvage value all cash flows occur at the year end. What is the negative NPV? To the, see, if they have not given us the money rate, okay, the money cost. Now it is nothing but the discount rate, okay, it is nothing but the discount. We have to calculate 1 plus money rate. 1 plus money rate is 1 plus real rate times 1 plus inflation. They have given real rate. How much they have given the real rate? They gave the real rate is how much? They gave the real rate of okay. Money rate is nothing but, money rate is nothing but, 1 plus real rate is how much? 1 plus real rate is 1 plus real rate is how much? 1 plus real rate is the estimated annual rate of inflation is 8%. The company real cost of capital is 12%. Is it right? The company real cost of 1.12, 1.08 minus 1. Is it right? 1 minus 1. It comes to how much? 1.12 times 1.08. It comes to 1.2096 or minus 1. Is it right? It comes to 0.2096 or 20.96%. This is the value of R. Now at this rate we have to discount it as simple as possible. Okay, at this rate we have to discount it. What we have to write? We have to take same process. Okay, we have to take particulars. Is it right? Particulars we have to take. Here we will take year 0, year 1, year 2. Okay, how much is the outlay? How much they are cost of cash outflow? How much is the cash outflow? Cash outflow is 18,000. Okay, cash outflow is how much? 18,000. Next, cash inflow is how much? Cash inflow is year 1 is how much? They say that labor savings would be 9,000 in first year and labor rates in the second year will increase by 10%. Fine, means labor savings is nothing but the cash inflow. Okay, how much is there? It is 9,000. 9,000. This is for the year 1. Okay, year 2 it will increase by how much? 10%. 10% means 9,000 plus 10%. It comes to 9,900. Okay, it comes to how much? 9,900. How much is the salvage value? They have estimate salvage value of how much? 5,000. Is it right? They have estimated salvage value of how much? They have estimated salvage value of 5,000 in year 2. Okay, in year 2. Now, that's all. Nothing is there. Okay, nothing is there. It comes to how much? It comes to 004, 14,900. It is 9,000. It is 18,000. Now you have to discount it. Okay, you have to discount it at the rate of 1.2096. Is it right? We have to take the NPV. Is it right? NPV. NPV is minus 18. Okay, minus 18 plus 9,000, 1.2096 to the power of 1 plus 9,900, 9,000, no, not 9,900. How much is there? It is 14,900. Okay, it is how much? It is 14,900. 14,900, 1.2096 to the power of 2. Okay, to the power of 2. How much you will get? NPV will be how much? NPV will be, just do the things. Is it minus 18,000 plus, is it right? Minus 18,000 plus 9,000 divided 1.2096. It comes to 7,440. Okay, 9,900 divided by 206. It comes to how much? 676766. NPV will be how much? NPV will be minus 18,000 plus 7440 plus 6760. It comes to how much? 3,800. To the nearest dollar. Okay, to the nearest dollar as such. Right? If you take to the nearest dollar, it will become how much? Or to the nearest dollar, is right? Nearest dollar 10. Okay, nearest dollar means it comes to how much? 380. Okay, it comes to how much? 380. Minus 18,000 plus 740 plus 6766, 3794. Okay, fine, it is rounding off, don't worry about that. Okay? 14,900 divided by 2096 10184. Sorry, is that right? Sorry, it comes to how much? It comes to how much? It comes to 10183.63, 10184 equal to minus 18,000 plus 7460 plus 10184. It comes to how much? It comes to 376. Or if you round it off, it is rounded off to how much? 380. To the nearest 0, okay? To the nearest 10. How much? It comes to how much? It comes to 380. Slowly we have to do, okay? A little bit, even you can understand, even we will just miss the things, it will make a lot of difference, okay? Now, a company buys a machine. It's not, you can have the clarity, it's not difficult at all, okay? Please subscribe to this channel and share this channel and post your feedback. I'm requesting you to give the feedback, okay? A company buys a machine for 10,000 and sell it for 2,000 for at time 3. Running cost is how much? Running cost is nothing but outflow, okay? 3,000, 5,000 and 7,000. In the last year we have to take what? We have to take this one, okay? How much you have to take? We have to take 5,000 because 7,000 is the cash outflow and 2,000 is it is going to be sell it off. All these are cash outflows, okay? All these are cash. If a series of machines are brought, run and sold in an infinite cycle of replacement continuously, what is the equivalent cost of the machine if the discount rate is 10%? What is the formula for equivalent cost? Okay, equivalent cost is nothing but NPV divided by R. Okay, I can say NPV. It is what they say that how many years? The annuity factor. Okay, annuity factor at the rate of R for n number of years, n years. Okay, again I am saying annuity factor at the rate of at the discount rate for n number of years. Proportionately we have to take. Here how many years are there? 3 years are there. Fine. Now here I will write here only. Here you have the cash flow. Is it? You have the cash flow. You have the discount factor at the rate of 10%. Present value at the rate of 10%. Year 0. Is it right? 0, 1, 1, 2, 3. Here is how much 0? Here is how much? 10,000. Okay, 10,000. Discount factor will be 1. Okay. Year 2, how much? Year 1 is how much? What is the cost? It's only a cost, is it? 3,000. Year 2 is how much? 5,000. And year 3, how much you will get? You will get how much? 7,000 is the cost. Salvage value is how much? 2,000. Is it right? Means how much it is there? It will be 5,000. 10%. We know. Now almost we are 0.909, 0.826. Is it right? 826, 0.7. You will also get it automatically. Okay. In the examination, it is not needed because you can get it from the Excel sheet. Okay. This is okay. Present value. How much is there? Minus 10,000. Is it minus 10,000? 2727. Is it 2727? 5,000 into 0.86. It comes under 4130, and 5,000 into 0.7751. It comes to 3755. How much it comes? Is it? What is the NPV? NPV is how much? NPV is minus 20,612. Is it? 20,006. Now what we have to do? We have to do equivalent annual cost. This is the NPV. Okay. Equivalent annual cost I have mentioned here. This is the formula. Okay. This is the formula. What is the formula? Formula is NPV divided by annuity factor for R at the rate of n years. Okay. Is it? NPV divided by annuity factor. How much is the annuity factor? And NPV, how much is the annuity factor at the rate of 10% for 3 years? 2612 divided by, if you put all the things, is it right? You put all the things here, it will come to how much? It will come to 2.487. Okay, 2.487. It comes to 8288. Okay, it comes to how much? 8288. Fine. Likewise, you have to do. The more we do the things, the more the clarity will increase. Okay, don't worry about that. The more we do the things, the more clarity. A company has 4 independent projects available. Capital needed. If the company has 32,000 to invest at time t, each project is infinitely divisible, but none cannot be delayed. What is the mag? See, if they say that it is having limited capital, it is nothing but capital rationing. If it is going to be capital rationing, we have to take profitability index. Is it right? We have to take profitability index. Okay, based on that we will do it. It's a now. First is project. Is it? First is project. Second one is capital needed. Capital needed. The third one is in what they have mentioned at time 0. Okay. At time 0. The third one is what? What they give you? They gave the NPV. They gave the NPV. Well, we have to calculate profitability index. Okay, NPV divided by what? NPV divided by capital needed. Okay, NPV divided by capital needed. Then we have to give the ranks. Okay, we have to give the ranks. Then how much is the investment amount? Is it right? Then we will take into consideration the NPV. Is it right? Now, these type of questions we have to work it out. This is column 1, column 2, column 3, column 4, column 5, column 6 and column 7. Okay. Now, project A. Okay, project, how many projects are? Project 1. How much capital is needed? Capital is needed is how much? 10,000. Fine. What is our NPV? 30,000. NPV divided by capital. 30,000 divided by 10,000, it will be 3. Okay. Till now we can do. Till now. Okay. Next 8,000. Okay. 25,000. 25,000 divided by 8,000, 3.125. Project 3, 12,000. 12,000. How much? 30,000. 30 divided by 12,000, it comes to 2.5. Project 4. Okay. Project 4. How much is there? 16,000. Fine. 16,000. 36,000. We have, keep it in mind, we have 32,000 with us only, investments. Okay, we have 32,000 only. 2.25. Okay, 2.25. We have to give rank. Okay, we have to give the rank. Okay, how my first rank will be for, this is the first rank, this is the second rank, this is the third rank. Is it right? Here what is the chances? How much is there? 36. Is it right? 36 divided by 16. Okay. How much is we will see it. Okay. We will see it. How much we can put it. How much we are investing here? See the thing. 10,000. Okay. Here how much we are investing? We are investing 8,000. Is it right? Here we are investing how much? Here we are investing 12,000. See how much is there? 10 plus 8, 18, 18 plus 2, 20, 20 plus 10, 30. Only how much we can have the surplus amount? 2,000 only. Okay. Only how much is there? 2,000 only. Means if you put 2,000, what will happen? It will be equal to how much? It will be equal to 32,000. That it will be equal to how much? 30. Means how? What is the chances? Make it a point. 2,000 divided by 16,000. Is it right? 2,000 divided by 16,000. It comes to how much? It comes to 1.8. This is rank 4. Okay. This is rank 4. Now see the things. When we are making the things, we have to think NPV also. Is it right? We have how much we can get the NPV. Here NPV is how much? NPV is 30,000. Okay, we take the NPV that proportionately we will take NPV of 1 by 8 only. Okay, 1/8 of the NPV. Okay, fine. How much it is there? It is 25,000. 25,000. Here it is how much? It is 30,000. And here how much we will take? Is it right? How much is the NPV? 36,000 times 1 by 8. Okay. 36,000 divided by 1.8. How much we will get? 36,000 divided by 8. 4,500. This is the maximum we will get. Is it right? Maximum NPV. If it can be delayed with respect to capital rationing. It comes to how much? It comes to 5, 9, 3 plus 2, 5 plus 3, 89,500. Is that? It comes to how much? 89,500. Fine. Likewise, we have to be little bit now. We have to be little bit more specific on that. Fine. Conceptually, we have to be very strong. Okay. By the time we start section B, we should be in a position to have the concepts has to be clear. The advantage of section A is the concepts will be cleared. A project has an initial outflow at time 0 when the asset is bought, then a series of revenue inflows at the end of each year, and then finally sale proceeds from the sale of assets. Its NPV is how much? 12,000. General inflation is how much? 0. See, think very. If general inflation is to rise 7% and all revenue inflows were subject to this inflation, but the initial capital expenditure and resale value of the asset are not subject to initial expenditure is not subject to inflation at all. Okay, that is the reason year 0 at any rate. Okay, at any rate, is it right? Value will be how much? Value will be 1 only. But what happens if R value increases? Is it right? If R value increases, what will happen? If R value increases, present value will decrease. If inflation increases, if inflation is increasing by 7%, R value will be also increased by plus 7%. Is it right? R value will also be increased by plus 7% and NPV will decrease. It is the straight question. The NPV will never remain same. It's not. NPV will rise. This is point B. Is it? This is point B. NPV would fall. Which two of the following statements of accounting rate of return, ARR method and the payback period method are two? These are the traditional methods. Okay, these are the traditional methods. Fine, traditional methods. When you are talking about the traditional method, both methods are effective. No, it will not take the cost of capital as such. Traditional methods. Okay. ARR does not take into account of returns over the entire period. Is it right? ARR, it takes into account average profits. Is it right? The concept is that average profits. Is it? This is also not true. The payback period is based on the project cash flows. Yes, profit after taxes plus depreciation is going to be identified as a cash flow. A requirement of an early payback can increase company definitely. What is the rule? Rule is we have to recover. Is it right? Recover as early as possible. If you are recovering, if the project life is going to be 5 years, is it right? If you have two projects, one is going to be recovered in 3 years and one is recovered in 2 years, then what we will do? We will prefer to take 2 years, because after 2 years, whatever the cash inflows are there, it is a liquidity asset. The answer is point C and point D. Okay. Fine. Indicate by clicking the relevant boxes which of the following statements in relation to simulation exercise. Is it in terms of simulation exercise? It considered the effect of changing one variable at a time. Which one? It indicates which of the following statement is relation to the simulation exercise. Is it right? It considers of changing one variable at a time. It is not simulation exercise, is it right? This is the sensitivity analysis. Sensitive analysis means we are changing one variable at a time. We are changing the discount rate. You change the discount rate, is it right? You change the value of R, is it right? You change the value of R. Delta is nothing but, if I use this sign, delta is nothing but the difference, change, okay? Change in value of R. What will happen? The present value will also change. Is it? The present value will also change. It is false. It considers what sensitive exercise consists. Sensitive exercise. It means sensitive exercise. Consider the impact of many variables changing at the same time. Simulation exercise, is it? Simulation exercise means what you are changing. You are changing every other variable, is it right? At a time, and you will see what is how the results will have impact. Simulation exercise directs directly to the correct investment decision. Simulation exercise points to the correct. See, it is not correct. Always it is estimates. Is it right? It is always an estimate. It says that it assesses the likelihood of the variable. Is it? It assesses the likelihood of it. Simulation exercise assess the likelihood of a variable changing. Is it? It more or less it is. It is not the variable changing. It talks about various other factors which are going to be considered in terms of possible outcomes. Okay, it takes into consideration what? It takes into consideration the possible outcomes as such. Fine. Now, when considering standard deviation as a statistical measure, which of the following statements are true? Okay, which are the following statements are true? See what it says. Standard deviation is a measure in the variability of distribution in its mean. Okay, it is nothing but what the x minus x bar, is it right? X minus x bar. Then you will get the sum of the variations. Root of variations is nothing but the standard deviation. Standard deviation is nothing but root of variance. In relation to the long-term lease, which of the following statement is not correct? All the risks and rewards of the ownership transfer to the lessee. Okay, all the see, when it is not correct, is it right? All the risk and rewards of ownership, it is correct. Okay, the asset and lease obligations will be recorded in the statement of, yes, it will be recorded in the statement of financial position. The lease period will cover almost all the lease assets useful. See, lease period covers all the lease assets, cover almost the expected useful life. Is it? The lessor will be responsible for the repair. No, why it is not the lessor? Who is responsible? Lessee. Is that who is responsible? It is the lessee. Fine. Next. What is the return on capital employed? Is that profit before interest and taxation? Profit before taxation. See, this is the last one. It will leads to the next. It leads to the next topic as such. Is it return on capital employed? Is it right? What is the return on capital employed formula? Profit before interest and tax. Is it profit before interest and tax divided by capital employed? Is it right? Divided by capital 2,500 divided by 10,000. Capital employed is nothing but debt plus equity. Is it right? Debt plus equity or equity plus debt, both are same, okay? 2,500. It comes to how much? 2,500 divided by 12,500 times 100, okay? It comes to 20%. Okay, it comes to 1. With this, we have covered the investment appraisal. Very short, very crisp, okay? Just go through this again in detail, and when we come back, please have in the study text, please read the things related to business, finance and cost of capital, okay? Business, in the next session, it will be business, finance and cost of capital. Thank you so much. Take care. Best of luck.